Hey everybody, Tim Albrecht here. Welcome to this week's episode of the YFP podcast, where we strive to inspire and encourage you on your path towards achieving financial freedom. Today, YFP co-founder, COO, and certified financial planner Tim Baker joins me to answer two questions from the YFP community. One on projecting life insurance needs, and another on how modified adjusted gross income is calculated to know whether or not you're eligible to make Roth IRA contributions. If you have a question you would like for us to feature on an upcoming episode, head on over to yourfinancialpharmacist.com/askyfp to record your question or send us an email at info@yourfinancialpharmacist.com. And before we get started, I want to let you know that we're now publishing the podcast in video form on YouTube. If you want to watch this episode, make sure to subscribe to the Your Financial Pharmacist YouTube channel, where we publish new shows each week. All right, let's jump in with our first question, which came to us via email. And that question is, my wife and I are pregnant and are reviewing our life insurance policies. If one of us passes away, does the other spouse have early tax-free access to use the deceased spouse's Roth IRA, 401k, SEP IRA, or solo 401k? Or would the spouse still have to wait until they are of retirement age, typically 59 and a half years old, to access? We're trying to determine how much more life insurance we need to buy with a new baby on the way. My wife and I are in our 30s. Tim Baker, what are your thoughts on this?
Yeah. So first of all, congrats on baby coming. That's monumentous. I feel like, Tim, having a baby tends to lead to some reflection about a lot of things, including finances, savings, life insurance, disability, estate planning, education planning. All those things kind of come to mind. I think if I'm answering this question, I separate these things in terms of like life insurance versus retirement plans. Because I think, especially when you're young, spending some money on a fairly inexpensive term insurance to keep those retirement plans unadulterated is worth it. Because one of the misconceptions is, like, when you retire, your expenses are going to be, I wouldn't say they're going to be the same as if there's one person versus two, but it's going to be, it's going to be pretty expensive. So I wouldn't look at that as insurance. So I think I would look at it in the confines of, like, okay, this is for the purpose of retirement, and this is the purpose of, insurance. So there are different rules for different types of accounts, and different types of beneficiaries. So, if you're both in your 30s, you're having a baby, if you're relatively healthy, I would look at term insurance. I always kind of talk about the rule of 30, which I have to look at, but basically, to see if that still holds, Tim. But the rule of 30 was you could buy a $500,000 term insurance policy, a 30-year policy, if you're in your 30s, for about $30 a month, right? So I'm sure prices have gone up since I've been talking about that. So I have to make sure that
Sounds about
still
right.
holds.
Yeah.
But I think that is important to understand. So, but if you're talking about the retirement plans, when a spouse dies, each of their assets are essentially transferred to the beneficiary. Most of the time, it's going to be you as the spouse, the surviving spouse. So there's really 5 options with these types of IRAs. So 401ks and 403bs will be a little bit different, but I'm going to speak specifically about IRAs. The first option you can do is you can keep the IRA. So a beneficiary can withdraw the funds even if they're younger than 59 and a half without paying a 10% early withdrawal penalty if the deceased has already started taking distribution. So in this case, that wouldn't be it because you're younger. A surviving spouse, a minor child, or a disabled person is required to take what's called RMDs, required minimum distributions, based on the deceased person's age rather than the beneficiary. If the heir is not a spouse, then there's different rules. So there's kind of spousal rules and non-spousal rules. One of the things to remember with Roth IRAs is that you can typically take out your basis or what you contributed without penalty or tax, right? So that's important to know off the rip. The second option is roll over the IRA. So beneficiaries can roll assets into a personal IRA without paying income tax or early withdrawal penalties unless they are 59 and a half. So a rollover into an inherited IRA does not incur penalties if the assets have been in the accounts for 5 years. And this option, Tim, is only open to a surviving spouse who must transfer to the same type of account. So traditional to traditional or Roth to Roth. The third option here is to convert to a Roth IRA. So that in this case, we're talking about a Roth IRA. You could also disclaim part of the assets. You say, I don't want it, or cash out the IRA. So in most cases, what I would say from a planning perspective, what I would say is don't think of your spouse's retirement assets as a form of insurance. I would say buy the insurance. But if you do get into a pinch from a cash flow perspective, you can access those funds, especially if you are the spouse and if you're looking at basis without taking the penalties. So there's a few different layers of sorts that I would go through before getting to a point where you can completely cash out the IRAs. But this is just like this is typically just like a backdoor Roth conversion. The flow chart on this can be very complicated in terms of, okay, when did they start distributing it? Did they not? How old's the deceased spouse? How old's the surviving spouse, et cetera? So it can be very complicated. So I think if I'm in my 30s, I'm basically layering a little bit more of term insurance where I feel comfortable, and I'm treating that deceased spousal IRA or 401k as if it's my own retirement plan and not not an insurance bump, so to speak.
Yeah, Tim, I like how you're separating out these two things. And I do love the question, right? Because there's an intentionality, and I can tell some in-depth analysis going on, that we're not just applying blanket rules of how much term life insurance do I need, but actually trying to get to the question which needs to be answered when it comes to buying term life insurance, which is, what do I need this policy to replace? And in this question, there's some background questions of, hey, well, if there are retirement funds, will those be accessible or not? I'm with you, right? If someone's in their 30s, not advice for them, but I would think of it the same way you are. If I'm in my 30s, baby's on the way, assuming relatively healthy, inexpensive term life insurance policy. If I'm looking at these two things, just to put some numbers to this, and I'm looking at, hey, maybe I'd need $1 million term policy versus a 1.5 or 2 million if I were to exclude these retirement assumptions. When you consider the cost of these policies, again, we're making some assumptions of health and other things, but based on age, like that feels kind of like a no-brainer, right? In terms of keeping it clean, separation of these two things, and relatively inexpensive, assuming that the monthly budget can handle the extra, whatever it'd be, $20-$30 a month to add on to the term coverage. So I like that, because I think sometimes we can make these things maybe overly complicated. And, I like the intent of the question, but I also like thinking of these buckets separately. And there's a peace of mind component here too, knowing that, hey, we've got the life insurance piece that's purely for the sake. Hopefully we never use it, but if it's there, we have access to those funds. Great stuff.
Yeah, and there are other things that I would potentially pull levers before I would even look at retirement plans. That could be, leverage in debt or other things, like a HELOC or something. I think even before I would start cashing in retirement plans. So again, I think it's all the reason to have, this is about planning, not a plan, all the reason to have a planner to kind of work through life events, and hopefully nothing like this ever happens. But I think it's a great thought experiment to kind of go down.
One last thing I'll say on this before we move to our second question is, for those listening that maybe don't have term life insurance, are wondering about, what's all involved in a term life insurance policy. How do I begin to think about and evaluate what the need is? Or if you have a term life insurance policy, wondering if that coverage is appropriate, or maybe you just have an employer policy and you're wondering about your own policy. We've got a very comprehensive resource, Life Insurance for Pharmacists, the Ultimate Guide, that will give some great background educational information on this topic. We'll link to that blog article in the show notes so you can read more and learn more on that. Tim, since you mentioned backdoor Roth, we gotta go there, right? So your favorite topic. Yeah. So our second question is, also came into us via email. How do you calculate modified adjusted gross income to know if you're eligible to contribute to a Roth IRA? What are your thoughts on this one?
Yeah, so a lot of us use MAGI and AGI synonymously. So modified adjusted gross income is not the same as adjusted gross income, although we use them the same. So to determine, so just to kind of throw out some numbers, if you are filing single and your modified adjusted gross income is 150,000, we'll say it's 150,000 to 165,000. Once it gets to $165,001, the door for you to be able to contribute directly into a Roth IRA shuts. So once your MAGI is $165,001, you can no longer make a direct contribution. So this is where you have to contribute to traditional, go through a bunch of steps, and then move it over to
Are you talking about
a
for
Roth.
individuals or joint filing?
That's for single filing.
Single filing,
For married filing jointly, the phase out is 236,000 to 246,000. So once you make $246,001, you cannot directly put contributions into a Roth IRA. So how do we get this number? The modified adjusted gross income. So really what you want to do is you want to actually start with AGI. So AGI, I believe, is line 11 on Form 1040.
Nailed it.
Awesome. So then you have to add back in certain deductions to get your MAGI. So these would be things like student loan interest deduction, which, a lot of people aren't getting that because they make too much money. Tuition and fees deduction, if that's available. IRA contributions deduction, if you're contributing to a traditional IRA and taking a deduction, also typically not available. It could be rental losses if the rental losses are subject to passive activity loss limits. Other things could be excluded foreign earned income, excluded employer adoption benefits, half of self-employment tax deduction, any passive loss or passive income, interest from Series E savings bonds used for education, and finally, losses from publicly traded partnerships. So once you add back these deductions, that gets your modified adjusted income, and that's gross income. And that's essentially the number that you use to say, okay, can I make a contribution directly into the Roth, or do I have to do a backdoor strategy to go from a traditional into a Roth? That's MAGI. So it's often the case for a lot of people that they don't have a ton there. So that's why we kind of use it synonymously, but there is slight differences in that AGI and MAGI number.
Tim, I think this is a really good question, not only from the Roth contribution, but you're starting to dissect the IRS Form 1040 a little bit, right? As you're talking through the different things, when we look at, the terms we throw around, income and gross income and adjusted gross income, modified adjusted gross income, understanding what are the above the line deductions, other deductions, credits, et cetera. Here we're talking of things that are above the line that you were listing off. But
yeah,
the reason I'm going there, and I'm not suggesting we need to go down the tax rabbit hole, but the more we understand kind of the flow of dollars from a tax standpoint and what these terms mean, we start to see some of the levers that we could potentially pull from a tax optimization standpoint, as well as being able to answer questions like this one, which is like, hey, can I make direct contributions to a Roth? Do I phase out? Do I need to consider a backdoor Roth? And then if so, what does that look like? And how do I make sure I'm doing that correctly? We've addressed that on the show previously as well.
Yeah, I've talked about this with tax. It's like, understanding the 1040 kind of gives you not the answers to the test, but you can kind of start to see visually how the form is populated. And then I think it can ultimately affect your behavior and how best to optimize. Again, I sometimes people do some crazy things just to get a tax benefit, which doesn't necessarily, fit with their overall financial plan. So it's kind of just doesn't make any sense.
Yeah.
But I think if you understand the construct of, the tax code and the tax form, then you can, your behavior can then be, slightly altered to optimize your tax situation.
Yeah. And if you're listening, hearing some of these terms, wondering what are these guys talking about in terms of, a backdoor Roth versus a direct contribution. We actually talked about this recently on an RX Money Roundup episode 18, and we answered the question, can I do a backdoor Roth IRA myself? That's why I was joking with Tim that it's his favorite topic to talk about. So we'll link to that in the show notes. Make sure to check that out, and you'll find a good resource there that will help you in your own planning as well. Thanks again to the 2 questions that we had submitted this week. And if you have a question as you're listening that you'd like to have us feature on an upcoming episode, head on over to yourfinancialpharmacist.com/ask YFP. You can record your question there, or you can send us an email at info@yourfinancialpharmacist.com. Thanks again for listening. If you like what you heard, please do us a favor, leave us a rating and review on Apple Podcasts, which will help other pharmacists find the show. And finally, an important reminder that the content in the podcast is provided for informational purposes only and is not intended to provide and should not be relied on for investment or any other advice. Information in the podcast and corresponding material should not be construed as a solicitation or offer to buy or sell any investment or related financial product. For more information on this, you can visit yourfinancialpharmacist.com/disclaimer. Thanks so much for listening. Have a great rest of your week.